Recording. All right, guys, welcome, welcome. I'm excited for today's conversation because we have um, a lady who is a wealth of knowledge. She is the author of the book Mastering Multifamily Underwriting. I know you guys have heard this book. I've mentioned it to you guys before. So I just want to start off because a lot of what we're doing here, everybody in this group, we're all evaluating multifamily deals, and we want to become a wise investor. And this lady here, Vassi Kapulian, has evaluated. She's evaluated over 1,000 deals, and she's been able to manage over $1 billion in underwritten several deals, being in her career as a broker, as an active investor. She is also working with investors and teaching them as well. So I am excited to have Vessi Kapulian here to talk to us about how to be a savvy multifamily investor and be able to evaluate a deal confidently. So I'm just gonna open it up to Vessi so that she can introduce herself to you guys and tell us a little bit more of like how her journey has been, and then we'll transition into some like Q&A questions. So Vessi, welcome. Thank you for being with us, spending your Friday evening with us. I know you're in West
Yes,
California, right? So you're
yes.
a little bit, yeah, it's not too late for you.
No, I was really looking forward to today's conversation. Actually, Wendy and I were chatting earlier, and I
Yeah.
said anything that has to do with due diligence,
Hmm.
vetting operators, vetting numbers. I really enjoy talking about this topic. So thank you so much for having me, Wendy. It's a pleasure to be here. But as Wendy mentioned, I'm Vessi Kapulian. I grew up in a very different time, a very different place. I was born in Bulgaria, grew up behind the Iron Curtain for a number of years. It was always my dream to come and study in the US, and the only way to be able to do that is through earning a full scholarship. There was no plan A, B, or C. There was the plan, and if that didn't work out, I would have not had that opportunity. So feel very blessed, very grateful that I was able to accomplish that. And after coming to the US, it was everything was incredible. But I went down the traditional path, like many people do, which is going to school, later on graduate school, and really joining a large corporate firm. And in my case, that happened to be a pretty large bank. So I was in the commercial lending industry for a number of years, and like many hardworking, smart professionals set on a mission to climb the corporate ladder. And there were a few signals along the way. It just took me a little longer to pick them up, but those were really events that caused me to step back and think about um, what am I really doing and how am I really protecting the risk, namely my own employer went through a number of restructures, and there was the 08-09 crisis. Prior to that, there was the Enron scandal, and a lot of these events left people without jobs, maybe at a time when they were not ready to retire, their portfolios decimated. And at that time, as I was thinking about, okay, I don't control the markets, I don't control corporate restructures. What is it that I can control? It was really the idea of building multiple income streams. And for me, that resorted to real estate. Why? Because when I was growing up in Bulgaria, there was no stock market. When people talked about investments, it was real estate and hard assets, and not necessarily even cash flowing real estate, but a hard asset that is a store of value. And so, as I was considering my options, real estate for me emerged as the national as the logical next step. In addition to that, I had the commercial lending experience, so that made the transition a little bit smoother, at least in terms of evaluating deals from a lender's perspective. So I bought my first property out of state. It was impossible to do that in California, given the regulatory
Mhm.
environment, price point, which required a significant amount of liquidity, and then my investment goals, which was cash flow. But so happy that I overcame that discomfort, really fear, and taking that first step, because that property changed my life tremendously. It opened up a whole new world of possibilities and opportunities. And so I started investing on the side while having a full-time job. And I'm glad that I did, because one beautiful day, my employer went through another restructuring, and our entire division was closed. Thankfully, by that point of time, I had learned the lessons right through what I saw happen to many colleagues of mine. And I had the option, right? The option to either stay on the corporate path or start my own business, which I wanted to do eventually. And I realized now is the time. I never want to look back 20 years from now and wonder what if, or have any regrets. So now I do what I do full time, which is specifically I work with founder-led enterprises, family offices, as well as sophisticated investors, and I advise them on governance, risk mitigation, as well as capital allocation. When I allocate capital, I selectively do that with apartments. I love the residential space, so haven't really veered off of that path. But to the extent my clients are evaluating other investment opportunities, this is where I can bring in the risk management angle to help them make informed investment decisions. So I know I shared a lot, so I'll pause for a moment, and happy
Yeah,
to follow up. Yeah.
yeah, that's so interesting. I mean, I think a lot of us come from the same background. We're like first generations here building something, um, working on climbing out of that corporate ladder, and we've invested as passive investors and looking to see like how do we wisely choose those investments that will make sense for us, and how do we move forward being smart about what we're going to invest in. And I we can relate to your story, so that's very, very interesting, actually very cool. I don't know if I knew that, but that is one of the things that I think is very impressive with the background that you have, being a lender. I'm interested to like know, Vessi, you've underwritten like several deals. So like what's one deal that you looked at that looked amazing on paper but was like a red flag? What was like one of the red flags maybe that you can immediately see as you are evaluating these deals to be able to bring them um to your investors?
Absolutely. Oh boy, there's so many that I can think of, but maybe I'll share two examples, right? One is, at the end of the day, this is still a people's business. And so actually before I even look at the numbers, I take a lot of time to evaluate the operator or the people behind the deal. And there I can definitely talk about some of the key aspects or the process that I go through. But one of the qualities that I look for is transparency, right? And that manifests itself in a number of different ways, as in terms of how they answer the diligence questions, what information they share, and how they share it. So there was an opportunity that I was looking at, and I usually ask for the underwriting model in Excel unlocked. And
Yeah,
so, and if they refuse to share, sometimes they would say, well, we can only share a PDF. That for me is an automatic no. So even though I had a very pleasant conversation, right, with that person, that if they're not willing to share such a basic thing as their underwriting model, I would be in a more precarious situation after you wire the money.
yeah.
And another example that comes to mind, and that's more numbers related, and I see that a lot actually with class C minus properties. A lot of times they look absolutely outstanding on paper. When you look at the numbers, the underwriting just works beautifully, right? But then when you really start doing your diligence on the market, which is the second step that I take before, again, I even look at the numbers, you realize, oh gosh, this may be in an area that's maybe not growing as much, or maybe in an area that I wouldn't dare set a foot in for
Right.
safety reasons. And so it's important to, don't get me wrong, numbers are important. By all means, I want to encourage everyone to perform deep diligence on that, but they're not everything, and there are a few essential steps we as investors should take before we even get to the deal, and that's the
Yeah.
people and the market.
Yeah, no, you brought up such a good point because I underwriting, it's just like a quote unquote underwriting a deal. We think of numbers right away, but we forget that it's more than just the numbers are important to look at. But so, like, in simple terms, like, what is it like under the umbrella of underwriting? You mentioned vetting the operators.
Mhm.
Anything else that is like, oh, it's falls under that branch of underwriting outside of numbers.
Yeah, yeah, no, I think the probably the more straightforward way to think about it is taking a step back and thinking through the various risks or events that can impact a deal, and
Mhm.
then understanding what those risks are, analyzing those risks, and then looking to determine, am I able to mitigate those risks, either through buying right, maybe structuring the deal in a different way, partnering with the right people, right? So it's really taking a step back and thinking through the risk framework of that particular investment, and
Yeah.
then tailoring, right, the numbers as well as return expectations and all of that accordingly. And there are a lot of different risks, right? We just talked about the people risk or the operator risk. There's the market risk. There's macro econ and global risks that inevitably impact a real estate deal, even though they may seem maybe not as directly connected. Insurance risk, financing and refinancing risk, interest rate risk, operational risk, and execution. So thinking through all of these aspects of the risk framework and really looking to assess, how does that impact my numbers? How does that impact my return profile? And to what extent, right, can I mitigate those risks? Because the one guarantee I will make, and I know we're not supposed to make guarantees in investments, but the one guarantee I will make is that you cannot avoid risk and you cannot eliminate risk. Investing inherently comes with risk. So the idea is not to necessarily avoid it or eliminate it, but to think through ways to mitigate it, right, or reduce the probability of adverse impact happening if and when those challenges arise.
Yeah. Yeah. Um, I want to like step back a little bit because
Yeah,
I
yeah.
wanted to dig into why like so you started um with that first deal, but what was your interest in multifamily? Why did you choose multifamily?
Oh, I love this question. I will say my journey has been very slow, steady, and incremental, right? I didn't necessarily wake up one morning and said, I'm going to do apartments. For me, it started with first a single family home, then a duplex, then an 11 unit, and then eventually I transitioned to apartments. And it was after a couple of single family homes that, again, the light bulb went on. I'm not sure why I didn't see that sooner, but the light bulb went on, and I realized, oh my goodness, this is not just a small retirement portfolio that can be my hedge against, again, events that I don't control. This
Right.
can actually be a full business that cash flows and provides that additional steady income stream, really multiple income streams once you start accumulating properties. And so I knew the residential space, I understood the residential space and, from a single family perspective. So the transition into apartments was for me the next natural step or the next logical step. That is not to say I could not have transitioned to other asset classes, but to me, it just seemed like the next logical step where I can apply not only my experience as a residential or single family home investor, but also
Mhm.
my experience as a lender. It just combined, the combination to me was logical. Um, Nothing to say that I could not have gone down maybe a different path if I had started differently, but that was just the natural path for me. And
Yeah.
and I love apartments, right? They're not, you're not going to get the most, the highest returns there, but on a risk adjusted basis, it's a stable asset class. I like to feel good that I'm doing good by doing well by doing good, right? Providing a safe, clean environment for people to reside in, building the communities, and there was also a certain level of fulfillment that comes with that particular sector. So
Yeah. No, and I absolutely think your background in commercial lending and having that experience on its own, it's been able to like transition now into your active role as a multifamily investor and looking at it with like a different lens. So like with that being said, how does a lender look at deals differently than an investor?
yes, I actually love that you asked this question because I view the analytical aspect of it is very similar, but there are a few differences. So as a lender, right, both as a lender and as an investor, we're thinking how, or at least should be thinking, how do I protect my principal and how do I protect the downside? With that said, the lender is primarily focused on the downside risk. What if things go wrong?
Yeah.
Not that they don't want the investment to be profitable, but they're not necessarily concerned with the upside. So very often, right, the investor would look at, sorry, the lender would look at how is this deal positioned today? How is it performing today? And if I was to take over, right, how do I get paid back, ideally fully, right? Or minimize my risk of loss. Whereas from an investor's angle, of course, you're also, or at least should be thinking, how do I protect my principal investment? But you're also in the business of getting paid, right, for
Right.
taking on risk. So it's also important to evaluate the profit potential, right? Because as investors, especially on the equity side, we're deploying capital into an investment that's inherently illiquid in nature. So at a minimum, you have to get compensated, right, for taking on that illiquidity risk. And then in addition to that, for any other risk factors, right, that you think may be present as you evaluate the opportunity. And you need to get paid accordingly, right? Otherwise, why bother taking on the risk? So evaluating the upside from an investor angle is especially important. So these are some of the subtle differences, but as far as how the lender would look at it, the process is very similar in the sense that they, first of all, they evaluate the people. I like to say that people pay back loans, not properties. That's the reality of it. Of
Yeah.
course, you take on collateral, so they evaluate the property, the market and sub-market, because if God forbid, right, they have to take over. They want to ensure that at least the collateral is there, or maybe any other additional support to help them pay back the property. And then, of course, last but not least, the numbers, because ultimately the cash flow from the property is what will service the debt, and the exit will eventually pay off the loan, whatever that exit event is, whether it's refi, sell, buyout, whatever it may be.
Mhm.
So so from that perspective is very similar, right? You start with the people first, market slash collateral, and then the numbers.
Right. I want to jump into it and I want to talk about your book.
Oh, yes, of
Which,
course.
by the way, everyone here is going to get a copy of your book for sure.
Oh, thank
I've
you.
been listening to your book, and you talk about, um, you break the underwriting into like 5 steps.
Uh-huh.
And the book is so easy to read it because you jump into like a character, and that character is literally like someone who makes so many mistakes, and she learns through like trial and error, and it's almost like, oh my gosh, like we are that person and
Mhm,
we want to learn, but we just don't know what questions to ask.
mhm.
And when we're jumping into commercial real estate and apartments, you talk about a like a framework. You talk in your book, you break underwriting into 5 steps. Can
Yes.
you walk us through that at high level a little bit more, for those of us, because there's a mix of like beginner investors and like a little bit
Okay.
more sophisticated investors. So if you don't mind, walk us through that, the 5 steps in your book that you talk about.
Yeah, yeah, happy to do that, and I appreciate you so much for sharing your impressions because the idea behind the book was to break down the deal analysis process
Mhm.
in plain English and to make it feel maybe less intimidating because when a lot of times people hear the term underwriting, right? They think, what is this complex things? I'm not a numbers person,
Yeah.
but the message that I wanted to share is that actually anyone can learn it as long as you're willing, of course, to invest the time in educating yourself. And it's important, right, for us as investors to first take a step back and really understand what are you investing in. And if you don't understand it, then don't put money, right? Oftentimes, um, we're at these cocktail parties or social barbecue parties, right? And you hear the next best thing that people are investing in, and you jump in by virtue of hype and social proof. But just because an investment was the right fit for your neighbor, right, doesn't necessarily mean it's the right fit for you. And all the stories, by the way, in the book, they're real stories. Just the names have been have been changed and locations have been changed to protect the innocent. But those are either
Yeah.
some of my own stories or those of other investors that I've interacted with, consulted, coached, etc. But when it comes to the five-step framework, and if I mention any terminology that you think maybe getting too complex, by all means, feel free to interrupt me. But it really comes down to taking a step back and evaluating if you think about it, the profit and loss statement of a deal and then the balance sheet of a deal. And thinking about the profit and loss statement, right? I start with the top line and evaluating the rents, rent comps, rent growth rate. Why rents? Because everything flows from the top line, right, to the profit number. And if you get that wrong, not only you're starting off from the wrong base, but as you project a certain rent growth amount year over year, you're also compounding that error. So it's very important to get that right or as close to right as possible. And then as we move through the P&L, right, it's making sure that you have a reasonable expense base with appropriate adjustments for insurance and taxes. Very often, right, I hear people say, well, we're going to do better than the last owner. And I mean, you can't run expenses to zero, right? So at
Yeah.
some point you really have to think what is realistic, especially in the current environment, right? Where operators, owners are getting pressured or squeezed from all sides, right? You have cost of materials is up, cost of labor is up, let alone you can very find qualified labor. It's a challenge in certain markets. So it's important to think through those line items. Then step number three, now moving towards the balance sheet side of the equation, that's the reserves. Do you have sufficient reserves for the rehab or the capital expenditures that you're planning to make? Do you have enough of a rainy day fund? And a
Mhm.
lot of times, when I raise this question with operators, they will say, oh, we'll just carve out a portion of the cash flow. And my follow-up then is, well, what if the cash flow is compressed or no longer present? Where
Mm.
will the money come from, right? And the only way you handle that is either pausing distributions or even worse, doing a capital call and asking investors for additional capital. And that is not to say that pause distributions or capital calls wouldn't happen otherwise, right? There are a lot of events that could could drive those decisions, but why not build a margin of error, right? And I think actually Bill Graham, right, and in his book The Intelligent Investor, granted that book primarily focuses on the equities market, but he talks about the margin of error. And as investors, we have to plan for that, right? Nothing goes perfect. I can tell you, especially in the investments that we get into, these are 5 to 7, sometimes 10-year deals. It's not a matter of if, but when unexpected things happen. So again, does that eliminate the risk completely? No, but it provides you with cushion to plan against those unforeseen events. Then the lending structure, right? Making sure that you get the loan value. Ideally, the deal is not going to be over leveraged, and we're
Mm.
seeing actually the impact of deals getting extremely high leverage, because all it took in this case in some markets was a 20 or 30% decline, and the lender will be fine, maybe unless their leverage was really high, but as an investor, you could very quickly be underwater if you take on excessive debt, if you don't manage or hedge against the interest rate risk exposure. So I look at that and making sure that whatever debt structure is in place aligns also with the actual business plan.
Mhm.
And then last but not least, right, is the cap rates, which
Yeah.
directly impact the valuation of a property. And again, I've said it before, I'll say it again. I am not Nostradamus. I don't even know what will happen tomorrow, let alone 5 years from now. So if that is my mindset, when I think about the future 5, 7 years from now, when we exit an investment, I'm going to assume that the market will get worse before it gets better. And if it doesn't, great. Then my profit at exit will be even higher, but really understanding, right, what basis are you buying the property at today and what basis are you looking to exit at? Because a lot of times it's, yes, execution is absolutely important, but how you buy and how you sell also determines the profits that you will make. So
Yeah.
just for a
Yeah.
moment, yes.
Yeah, there's a lot to like take just from what you just said. Um, I want to take a step back as and be on like the shoes of a passive investor as a
Mm-hmm,
limited partner.
mm-hmm,
You work with several, and you and I know we're helping them make the right
mm-hmm,
decision.
mm-hmm.
How do you guide them? How are you able to work with them and give them guidance on whether it's a good investment for them? Um, so I want to kind of see what you walk them through to make sure that a deal, like just to make sure they're asking the right questions. What is something, if we were to be a limited partner on a deal, what would be the right question to ask?
Yeah. As far as private investors that I work with, I always start by taking a step back to understand if this investment is a right fit for them, what their goals are. Because again, what I do is not necessarily for everyone. I love real estate, but and it was the right vehicle for
Yeah.
me, right, based on my goals and my investment thesis, but it may not be right for others. So I go through a very extensive process to really understand where they're at, what their liquidity position is, what their risk appetite is. And then based on that, we can come to a mutual conclusion if now is a good time or not. When it comes to passive investors who have maybe made the decision to invest, but they need that second set of eyes on a deal, which I also help with those kinds of evaluations. I go through a similar process, perhaps not as in depth, right? But I want to really understand, what are they looking for? Are they looking to mitigate taxes? Are they looking for cash flow? What exactly is their primary goal? Because then that helps me evaluate the deal from that angle, right? If they bring me a deal for a second set of eyes, and their goal is cash flow and it's not there, or perhaps the numbers are a bit rosier and a little bit more optimistic than where reality is today, then these are the points, right, that I will highlight for them. So or even capital calls. That's another, the last 2 years, I would say those types of requests have been very frequent. But even with capital calls, right, what I tell investors, you have to treat it as a brand new investors now in this investment. And now in this case, you have the benefit of knowing the operator, the benefit of knowing the deal because you've been in it for some time, but it is still net new money, net new capital that you're deploying. So it's important to go through the process with the same amount of rigor and diligence.
Right. Yes. Yeah, I completely agree with you. How that's something that it's always, we're always having conversations with investors to make sure that whatever financial goals actually line up with the investment, and make sure that what they're looking for, whether it's more cash flow, like you said, or more of the equity, or tax benefits, or whatever the case may be. It's making sure that it is a good fit for the investor and with the investment. How important is the market? And do you have any specific, like, do, do you go to for analyzing market?
Oh my goodness, it's so important. And I love that you asked this question because as I like to say, right, the market drives the inputs or determines the inputs that drive the outputs for the cash flow and return projection. So it's after vetting the operator, right, the market is the second step or the second diligence item that I look to understand because I'll give you an example, right? There was a deal that an investor brought to me. They were looking to deploy capital. They needed a second set of eyes. And on paper, you look at the deal, you see 3% rent growth, and you think, oh, that's conservative. And that's the default in many models, right? So a lot of people default to that 3% and label it as conservative. But when I did a deeper look at the market, the historical run rate for that market was closer to 2%. So unless they can show me why 3% is substantiated, right? It was actually aggressive for that particular deal, but without having the full context of the market, I would not have known that. And again, on paper, 3% seems, especially in this environment, well, this environment maybe not so conservative, depending
Yeah.
on the market, but
Right.
there's certain markets that are now, for example, they're strong markets, right? When you look at the key performance indicators around population growth, job diversity, they hit all of these criteria, but unfortunately, a lot of these strong markets got caught up in an over supply environment, and that inevitably is now impacting rents. And so I said that historically 3% may appear conservative, but in fact, in some markets, we're seeing rent decline. And
Mhm.
so there was another deal that I looked at, right, where the last 2 years rents had been declining, and like last year it was down 2%, and the operator was projecting 0 in year one, then 10% in year two, and I think 3% in year three and thereafter. And I pressed them, right? Like, why? I mean, if the market is is declining, why are you projecting a flat rent and really a very optimistic rent growth in year two? And they pointed to a forecast report, but at the end of the day, a forecast is a forecast, right? It may pan out or it may not. So It's important to, again, get things close to reality, especially for me when it comes to rents and cap rates, because those have the most potent impact on the valuation of a deal, irrespective really of asset class. But I know we're talking about apartments now, but so if you get these wrong, it's very difficult to catch up.
Yeah,
So you
yeah,
don't want to be playing catch up
right.
on day one.
Do you um do you like a certain website or resource for
There are
evaluating market?
there are several actually, because I go through literally each KPI, and actually in the book, there are a lot of resources. So,
Yeah.
one of the resources I added was a market vetting GPT, and of course, it doesn't eliminate the need to do deep diligence on the market, but it gives you that preliminary diligence. And actually, in the book, it's a pretty lengthy list of like
Mm,
websites and that are I list both free resources and paid resources. But we have the luxury, right, of the internet, and now the luxury of AI, where
right.
you can still access a lot of good information around crime rates, around population growth, job growth, at the tip of your fingers. Now with supply and demand, and those will be like the Bureau of Labor and Statistics, the census, right? Those are the sources, and a lot of sites feed off of that data. They just present it in a more easy to read, visually appealing way. Because it is a bit overwhelming when you go to the census or the BLS, but they're the source data. So I would always recommend start there first. And then when it comes to supply demand, again, my favorite resource is CoStar. Now that's a paid resource, so we as investors, unless you have subscription, right, don't get access to it. But oftentimes the operator or the sponsor, the lead sponsor who's undertaking the deal will most likely be looking at that report or an equivalent. Sometimes they may not subscribe to CoStar, maybe they subscribe to Yardi or RealPage. Any of those is good.
Yeah.
And I like to look at those to really get a good grasp of the demand and supply, because again, you may have an extremely strong market, but if you see that it's going to get flooded, right,
Yeah.
with apartments, for example, over the next year or two, I'm not saying don't do the deal, but then underwrite it accordingly, right? With the appropriate concessions, appropriate rent growth or rent decline,
Yeah.
appropriate vacancy factor. Oh, then you can bake that all in upfront, knowing what you know with the information available today.
Do you use a specific template, Excel template?
For deal analysis, I pretty much ask the operator to share their
There.
unlocked underwriting
Yeah.
spreadsheet with
Okay.
me.
Do
I
you,
like to use theirs mostly because, and I started with one and it's evolved over different models over time, but
hmm,
each model is unique and they're not the same.
yeah.
So when I evaluate a deal, I like to compare apples to apples. So if I end up using my own model, then I'll be comparing apples to oranges, and it's just more efficient for me to just look at their spreadsheet and start
Makes
poking their.
sense. Yeah, no, that makes total sense. Yeah. Yeah. If you were to give someone who wants to become a confident, risk smart apartment investor, what would it be? If it was like one piece of advice.
Oh wow, I wish it was that easy. So many, but I would say get educated. That's the first
Yeah.
step. Don't rush into the process, because again, when it comes to apartments, you're deploying hundreds and thousands, and especially if you're working with private investors, then millions of dollars of capital. So it's important to take your time to verify the information first, whether that's verifying the operator and their background, verifying the market, verifying the deal numbers before you trust. And you're only going to be able to do that if you really understand how the deal works, if you really understand underwriting. I tell people, irrespective of what you decide to do, whether it's deploying capital, whether it's sourcing deals from owners or brokers, or even asset managing, you don't have to be a Wall Street analyst or a guru, but you absolutely have to understand underwriting. And I had a conversation with someone the other day, because AI right now is a big topic.
Mm,
I'm definitely incorporating it into my business and even in my vetting process, not necessarily to replace the due diligence, but to help me be faster, efficient, and screening deals. And so someone asked, well, are you afraid that that will replace the underwriting? I said, no, it will replace the mechanics of it, right? The data entry, all the manual activities, but it cannot necessarily replace the human judgment. And especially if you're allocating capital, the last thing you want is to be sitting in court and answering a question. Well, I relied on a black box AI model to do the analysis for me, and it said
mhm.
it's a good deal. And we're still at the early stages, right, of AI, where it's still hallucinating, but you wouldn't be able to catch those hallucinations unless you really understand how the process works. And so if there's the very first step I encourage people to take is really get educated on the process, on the asset class, so then you can spot those patterns or red flags, and looking at a ton of deals, right? It's like working out or learning how to dance, right? It doesn't take you don't just go to a class and all of a sudden you're salsa dancing. That's not going to happen, right? You take multiple classes, steps, practice, 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 and then it's part of your muscle memory, right? And it's very much or like a foreign language, right? If you don't
Mm,
use it, you lose it. So the only way to keep that muscle power is to keep reviewing
doing it. Hmm.
deals. And over time, that will also very quickly help you assess deals. After you've reviewed hundreds, you're going to know within 5 minutes, right, whether a deal deserves more of your time or if you should move on.
Yeah. Oh my gosh, that's so good. I could do a deep dive on what you just said just now. But I wanna kind of just make this call also an opportunity to talk about what inspired you to write this book. I think you did it for people like me, like for people who are like when we were so new to investing in apartments and we wanted to learn underwriting, we knew it was important. And the book is really good. That's why I always say, um, someone out there has already discovered the secret and they've written a book on it. And you're one of those for me. So I was excited to find out that you had written a book on underwriting, which you break it down in very easy to understand, and you provide a lot of resources on your website. So what inspired you to write this book?
It was really the burning desire to create positive impact. I actually had on my Vivid Vision board 3 years ago to write a
Yeah.
book that makes a positive impact, but I didn't have the
Mm,
topic in my mind. I had been producing a ton of content all along, but I I have to say what really motivated me to take that next step is because I wanted to be part of the solution. It's no secret, right, that commercial real estate is right now going through its winter season, and multifamily being part of it is impacted. And over the past couple of years, right, a lot of conversations I had with investors revolved around help me make a decision on a capital call, or is my deal in good standing. And what I realized throughout this conversation, or sometimes I would even see colleagues, right, start pushing emails, invest in these deals, and they're literally just forwarding the email, and
mm,
which then raises the question, well, have you really even evaluated the deal? And unfortunately, a lot of some of these deals that I've seen are now in trouble. And as I took a step back, I realized it's not these are very smart, very accomplished people. It's just that they don't have the right tools or the right knowledge to be able to make that assessment themselves. But secondly, again, the process can be really overwhelming if you're not in finance, combing through that terminology and really trying to understand it. That also takes additional time and effort. And again, it's almost like a foreign language. So the goal
Yeah.
is to really break down the process in simple steps and
Mm-hmm.
really be part of the solution. I figured I cannot clone myself, although, again, when I started writing the book, AI was just coming on board. I think now you can even do AI clones and all that, but at the time that wasn't an option. So I figured that's how I will be part of the solution, is write a book that not only breaks down the process in plain English so anyone can understand it, anyone can follow it, but also I wanted to provide the lender's angle. And I have a whole bonus chapter in the book that talks about what lenders think about how they evaluate deals, their underwriting process. Because as an investor, right, the lender is our largest partner. So it's important to understand that mindset. And I felt like a lot of other books on the topic were perhaps missing that angle. So I wanted to include that in the book. But long-winded answer because it was a long journey until I got to that point.
Yeah, yeah, yeah. No. Um, the book is great, and I think it's such a great way to give back with the experience that you've gained throughout the years and helping people make confident, smart decisions and educating them and helping educate them and providing them with the resources. So equipping people so that they make smart investments. And this is the book that I think it would have helped me when I started, and it was, when I was so new into multifamily. Like, this is definitely the book that I would have like sat down, read. Like, it comes with so many great questions for you to
Mhm.
ask uh, on a deal if you're ever presented on a deal, to ask those smart questions and be guided the right way. So yeah, I think that's pretty cool. So you guys, I'm gonna open it up because we have like maybe 8, 10 more minutes with Vessi. If you guys have any questions, and yes, I will drop the link for her book so that you guys can go and get a copy. But everybody here, especially if you guys are my clients, coaching clients, you guys get a book anyway. So Lena, you're good. But I'll drop the link too if you guys want to share it with anyone that you guys know would benefit from this book. So this is the book. If you're a beginner investor, get this book because it's gonna help you like expand the way that you see um, getting into multifamily. But feel free to mute, you guys. Vessi is here for maybe 8 more minutes, and we can ask her anything if you guys have any questions for her, anything at all. Because I know we were talking about this before we jumped on the call. We were talking about like the part that gets really tough when you have to look at so many deals, and then so many deals get presented to you, but it's taking the time to understand what you're investing in. And you said that right now, when you're like, you're going to look at so many deals and a lot of them are not going to pencil out, and that's okay. So I know that the mindset has to be there to say no, because sometimes the best investment is the one that we're going to turn away. And I showed you my little sticky where it says rejection is part of the process, because
Yes.
so
It's so real though.
yeah, anything around mindset, anything of like what drove her. She just shared her story with us, immigrating to this country and building this, and now she's giving value outside of just her time here with us with her book. So yes, feel free to just unmute, you guys, or introduce yourselves to Bessie. I'm gonna look for the link and put it in the chat for you guys.
Oh, thanks, Wendy. Yeah, and it's available on Amazon as well. So any depending on how you consume audio, digital, print. So I appreciate you sharing that. But yeah, I welcome any questions. There are no any question is appreciated. Here to help and share what I know and hopefully add at least a little bit of value.
Exactly. Give me 1 second. I'm not sure if someone's trying to get in the call. I want to make sure no one's waiting. No, I think everyone said. Yes, don't be shy. Feel free to ask Bessie. I'm going to drop the link in here. There's no right or wrong answer or questions, which I think most of us are with family anyways. But if you're able to unmute, let me drop the link. But yeah, I have the book. Bessie, I have your book in
Oh,
Audible.
thank you.
I have them both.
Yeah. Oh, wow, thank
But
you.
but it's good to listen to it. So I think sometimes it's good to listen to the book and then go back, and then highlight any specifics on the book as well. So, yeah.
Yeah, I'm the same way. I
You're
like
the
to
same way.
listen, yeah, listen and then yeah, for some reading is also it helps me internalize as well. So but the
Yeah.
audio helps if you're maybe have a long drive, right? So I can definitely relate
Turn
to
your book into a classroom. Okay, I think I found it. Yeah, it's right here.
Hey, Wendy.
Hey.
Hey, Bessie, I just have a question, and it's more related with the, let's say, beginner investor. How
Mhm.
do you help them to break the belief that investing in real estate, even if it's you're investing in a property and you have, the physical investment that you can see it, how can you help them to break that belief that is risky besides the underwriting? Because one of the tools that we have is the underwriting to show that this is the risk that no matter what you're gonna take, but this is how do you mitigate that risk. Besides that underwriting, what could be another way to kind of like give peace of mind to the investor?
Yeah, no, I love that question. Oftentimes what I find that if they're not certain about the investment, even if you uh, share with them all the data, all the information, all the work, right, that you've done to make sure this is a solid investment and risk mitigated, it really comes down to a couple of factors. One is making sure that they know, like, and trust you, or in this case, me, right, as an capital allocator and investor, and how I help them bridge that gap, right, is building a relationship gradually over time, and also sharing my knowledge, sharing my experiences. Of course, it doesn't happen in a single conversation. Bringing in relevant experience. In my case, that was the lender background that came into play. Maybe you have different experience related to whether that's real estate or managing projects. Basically, giving them the confidence that, okay, Vessi really knows what she's talking about, right? In the beginning, I struggled with that as well, because many people thought I was basically the commercial lender. And when I first started talking about real estate, they said, "Oh, you're selling homes now? You're a realtor?" I said, "No." And that was my fault, right? Because when I first started talking about investment, I just assumed that they'll make the connection, and that was not the case. And then the second area, so the believe in me, right, as an operator or as a capital allocator. And then secondly is believing in the asset class. Real estate was the right vehicle for me, but that may or may not be the right vehicle for everyone. And usually, again, if they're hesitant to move forward, is because they're doubtful. Will that work for you? But how do I know it's going to work for me? Or sometimes I even have right conversations with investors, and we quickly figure out they want minimum like 20-30% return, right? Their risk appetite is very high. Well, then you're probably going to be really frustrated with real estate, because 20-30% you can probably take on a new development deal that's maybe higher risk, but maybe you'll be better off in investing in VC, right? Maybe that's the right vehicle for you. So if they don't believe in the vehicle, that would be another reasons why sometimes they pull back. And that is not to say that they or will not change their mind, but to me, what that signals is, okay, they need more time to learn, they need more time to understand. So in that case, it's again continuing to build that relationship over a long period of time and sharing with them educational content, educational information, being a resource for them. And at the end of the day, they may decide to do something completely different. But if you take the time, right, to help them learn, then over time they develop that comfort. They see your processes, they see how you do deals. But yeah, my natural inclination was it's all about the data, right? I'm a banker, so I connect really well with like engineers, right? Because they're very data-driven people, but not everyone is like that. Sometimes people need to take 1 or 2 steps back to take 2 or 3 steps forward. So it's really understanding where they're at in the process and then adjusting the conversation accordingly. And being transparent. If I see there was an investor, for example, when they first heard that I am investing in real estate, right? They wanted to place 250K. I'm like, hey, wait a second. Let's first take a step back and understand where you're at. And then going through the process, I realized that the 250K, that was pretty much their entire savings account. So I was like, no, you should not be investing. And they got a little bit like, so why are you telling me this now? I said, no, you can invest with maybe a smaller amount. Don't put your entire excess liquidity or excess cash in the first deal with me. I'll take good care of it, but if you need that money in the next 2 to 3 years, these are liquid investments, right? So don't maybe put 50K, start small, see if you like it, and then increase your allocation. So also when you're transparent with them and maybe tell them something they don't expect to hear, but it would be for their benefit, that's also building credibility and trust over time.
Okay, great. Thank you.
Mhm.
Hi,
Yeah,
Bessie.
and oh, sorry, Lena, go ahead.
Okay. Hi, Bessie. Thank you for this information that you give to us. I would like to ask about the age of the buildings. What do you recommend, or I would like to know if the sponsors are interested in all buildings, because I was looking and I find buildings from 60s,
Mhm.
50s sometimes. So are mm, talking about the age,
Mhm.
could they be a good deal for them?
Oh boy, it really depends, right? And that's where knowing the market is really important, right? Because if you tell me, and for example, Memphis is a market I know well, guess what? The properties there are very old. Unless you start going out in the suburbs and you can find newer construction there. But a lot of times the age of the building is a function of the market, right? Or East Coast would have a lot of those characteristics. I would say Jacksonville, that's another market. And there are many more where the typical product is older vintage, right, types of properties. So if you're not comfortable investing in older properties, then taking a step back and really reassessing, do I really even want to be in that market? But it really comes down to the investor's comfort level. Now, inherently, older properties, they do come with additional maintenance, and could they be great investments? Absolutely, right? But you have to underwrite it accordingly, right? I looked at a deal the other day, and their repairs and maintenance budget was like $100 per unit per year for a property that was 1960s. Well, automatically my hair went up because I mean, I've also operated properties. I know you absolutely cannot, no matter how many renovations you do, you cannot run the property at that repair and maintenance budget level, right? You can change the interior and put nice countertops and all that, but unless you tear down the building, change the plumbing, the electrical, the bones
Yeah.
of the buildings are still 1960. So could they be great investments? Absolutely, but then you have to underwrite it accordingly. And then really what it comes down to is price, right? Now, conversely, and can you buy it on a really good basis? Now, conversely, like for a brand new property, sometimes people ask me, would you invest in a Class A? And I'm a bit hesitant, right? Because in the Class A, you're effectively riding the market, right? Because there isn't a whole lot of, maybe there's some value add, but not a substantial amount of value add. So really, you're really counting on creating returns out of the rent growth. But what if that rent growth doesn't come? And we're obviously going through a ton of markets with brand new product that's now heavily discounted because they have to fill the units and all that. And so naturally also the risk profile of this property is lower, but then the return is lower. So then the question becomes, well, that may not be the right fit for me, right? But what if you're an investor who likes clipping like 3-4%, who's going to be holding forever? Then that may be the right fit for them. So it really depends on, well, first of all, what is the market, right? Because there's certain things you cannot change unless you rebuild the entire Memphis, right? In my earlier example. And then how does that align with my investment goals and my risk tolerance as an investor? And that decision then becomes very clear. Is this a sector I want to participate in or not?
Thank you.
Great questions. I'm loving all the questions.
I just shared your website because Bessie's she's also a mentor and she coaches people with underwriting. So this is what she does all the time. She's teaching people and then obviously going in a deeper dive. But we were able to enjoy her for 1 hour, but there's just so much more that we can learn. So I dropped that information there for you guys if you want to check it out. But Bessie, thank you so much for sharing your knowledge and your experience and for spending your time, your Friday evening with us. You also raise capital, I know, and that could be a whole different subject on its own because then that would, like it's all one piece, but I definitely wanted to make sure that we spend some time talking about your book, asking questions around underwriting, and we'd love to have you back at some point in the future. So thank you so much for your time. And for helping us create that clarity to be confident, to look at and analyzing intelligently. We're also gonna, like I mentioned to you, we're gonna share your book and make sure that everybody gets their hands on your books because there's more resources there.
Oh, thank you. Thank you. Thanks for having me. I really enjoyed the questions, the engagement from the group. You guys are in great hands with Wendy, and really, again, appreciate the opportunity to share my message. And hopefully, you took at least one thing that you can implement in your investing process starting tomorrow or next week. And hopefully, what I shared added value. So thanks again. Thanks for having me.
Thank you. Thanks so much. All right, guys, I'm going to start recording.